Hi everyone, my name is Dharmo Soejanto and I'm the Chief Investment Strategist at UOB Asset Management. Global equities went up in the first quarter of 2023, similar to the previous quarter. But it wasn't a smooth ride. Market rose in January because inflation looked more reasonable and investors were hoping rate hikes would end soon. But in February and March, central banks signaled that this would not happen anytime soon, so markets fell back. People will remember that March was when Silicon Valley Bank and Credit Suisse events happened. However, central banks managed to reassure investors and markets stabilized towards the end of the month. Like equities, bonds gained in the quarter despite the volatility. In February, two-year Treasury yield hit 5% for the first time since 2007, but fell again in March. Ultimately, global bonds gained about 2.6% for the quarter. Chinese equities did well in January because of the ending of zero COVID-19 restrictions and pro-growth policies. In February, there was some profit-taking. Plus, the shooting down of the Chinese balloon over US airspace again caused investors to worry about US-China tensions. Overall, Asian equities ended the first quarter with a 3% gain. We had a positive quarter for all our portfolios. The very conservative portfolio was up by 3.3%. The conservative portfolio was also up by 3.5%, the moderate portfolio by 3.9%, and the aggressive portfolio by 4.9%. Finally, the very aggressive portfolio gained 5.7%. The largest contributors were global government bonds and US and Asian equities. We expect global economic growth to slow but not drastically. This will lead to a shallow recession or what we call a soft landing. We are expecting interest rates to peak, but stock markets will continue to be volatile. That said, markets can recover and move up swiftly once investors look past the slowdown. So by the end of the year, we expect global stock markets to be in better shape, and we are particularly optimistic about Asian equities and bonds. Given that we are expecting some market volatility to continue in the first half of this year, we are making a few small shifts to the portfolio that is outside of the normal quarterly portfolio rebalancing cycle. Within bonds, we are allocating more to high-grade government bonds instead of corporate bonds. Within equities, we are shifting slightly from US REITs and equities towards global equities and global high-yield bonds. We think that this adds more diversification to the portfolios and also takes away some of the emphasis on the US. As I often stress, short-term market volatility is part and parcel of investing. Where possible, investors should aim to sit out short-term volatilities rather than realize their losses. Also, it may seem counterintuitive, but when markets are volatile, this is the time to start investing small amounts over regular intervals. This is the way also used by professionals to lower your average asset cost when markets are volatile.